In 1602, a group of Dutch merchants did something that had never been done in the history of the world. They invited the public to buy a share of their company. Not a loan, not a partnership, a share, a small piece of ownership in a commercial enterprise, tradable on a public market to anyone who wanted one. That single idea, the publicly traded stock, changed the entire architecture of capitalism. And the company that invented it became the most powerful commercial enterprise in human history, with a value that dwarfs Apple, Amazon, and every other modern corporation combined. Today we're going back to Amsterdam, 1602, to find out how a small trading company invented modern finance and what eventually destroyed it. To understand why the Dutch invented the stock market, you need to understand what spices meant in the 16th century. Black pepper, nutmeg, cloves, cinnamon. These were not just flavorings. They were the most valuable commodities in the world, worth more by weight than gold in some markets, used to preserve food and display wealth. The problem was getting them. Spices came from the Maluku Islands, halfway around the world from Europe. The journey took years. Ships were lost. Sailors died. And the Portuguese had controlled the trade routes for nearly a century, making the whole enterprise brutally expensive and dangerous. Dutch merchants had been making the voyage independently, each funding their own expeditions. But competition between them was destroying profits, undercutting each other in European markets, driving down the very prices they risked their lives to earn. Something had to change, and what they came up with was so radical, so counterintuitive, that it reshaped the global economy for the next 4 centuries. Each voyage required enormous upfront capital: ships, crews, supplies, weapons for defense against pirates and rival powers. A single failed expedition could bankrupt an individual merchant overnight. And with dozens of Dutch companies competing for the same limited pool of spices, prices back home were collapsing, even as costs abroad kept rising. The Dutch government recognized that fragmented competition was weakening the entire nation's position against Portuguese and Spanish rivals. If Dutch merchants kept undercutting each other, none of them would survive long enough to build lasting wealth or lasting power in Asia. A unified solution was the only way forward. In 1602, the Dutch government merged 6 competing trading companies into a single entity, the Verenigde Oost-Indische Compagnie, or VOC, the Dutch East India Company in English. The VOC was given extraordinary powers no private company had ever held before. It could sign treaties with foreign nations. It could raise its own army and navy. It could wage war, build forts, and govern territories in the name of the Dutch Republic. It was, in almost every meaningful sense, a state within a state, a corporation with sovereign powers. But the truly revolutionary thing was how it was funded. The VOC issued shares, 6.4 million guilders worth, to the public. Any Dutch citizen could buy in. A wealthy merchant could buy thousands of shares. An ordinary Amsterdam craftsman could buy one. And crucially, those shares could be bought and sold on a public exchange. The Amsterdam Stock Exchange, the first in the world, established that same year. For the first time in history, the risk of a commercial venture was spread across hundreds of investors rather than resting on the shoulders of one. And the profit, if the ships came home, was shared in proportion to the stake each investor held. This is the mechanism that still underlies every stock market on Earth today. What began as a practical solution to a funding problem became the foundation of an entirely new economic system, one built on shared risk and shared reward. The numbers are almost impossible to comprehend. At its peak, the VOC was worth approximately 78 million guilders, equivalent, by most modern estimates, to around $8 trillion in today's money. That makes it the most valuable company in history, by a significant margin. Apple at its peak was worth roughly $3 trillion. The VOC was more than twice that. Between 1602 and 1796, the VOC sent almost 1 million Europeans to Asia, more than the rest of Europe's trading companies combined. It operated nearly 5,000 ships. It employed around 50,000 people at any one time. It controlled trade across the Indian Ocean, the Persian Gulf, and the South China Sea, functioning less like a business and more like a global empire with a balance sheet. And it paid dividends. The VOC paid its shareholders an average annual dividend of 18% for nearly 200 years. To put that in context, if you had invested £10,000 at 18% compound annual return, after 200 years, you would have more money than exists on Earth. The VOC was, for its era, the most successful investment in history. Merchants who bought shares in 1602 passed those holdings to their children, who passed them to their grandchildren. For generations, being a VOC shareholder was among the most reliable paths to sustained family wealth anywhere in the world, a fact that made the eventual collapse all the more shocking to those who lived through it. Here is where the story becomes uncomfortable, and where the honest version of history has to go. The VOC's profits were built on violence, on monopoly enforced at gunpoint, on the systematic exploitation of the people who actually grew the spices, and in many cases on slavery. The Banda Islands Massacre of 1621, where VOC forces killed or enslaved virtually the entire population of the nutmeg-producing islands, is one of the most brutal episodes of early colonial capitalism. The VOC did not invent capitalism, but it did demonstrate, early and clearly, that the mechanisms of capitalism, joint stock companies, public markets, limited liability, are morally neutral tools. They amplify whatever human intentions they serve. In the VOC's case, those intentions included both extraordinary innovation and extraordinary violence. That tension between the financial genius of the joint stock model and the human cost of how it was deployed is one that capitalism has never fully resolved. The VOC just made it visible first. Modern corporations rarely wield literal armies, but the underlying question the VOC raised has never fully gone away. What obligations does immense commercial power carry with it, and who gets to decide how that power is used? The VOC answered that question with force, and for nearly 2 centuries, nobody with enough power to stop it chose to. That silence, the willingness of investors to keep collecting dividends without asking how they were generated, is itself part of this story, and part of every story like it since. So what killed the most powerful company in history? The same thing that kills most powerful institutions: corruption, complacency, and the failure to adapt. By the mid-18th century, the VOC was paying dividends it couldn't afford, funding them with debt rather than actual profits. It was taking on loans to cover operating costs, while pretending to shareholders that the underlying business remained healthy. It was, in modern terms, a company cooking its books. The British East India Company had grown into a serious rival. Smuggling was undermining the VOC's monopoly from below. And the Fourth Anglo-Dutch War of 1780 devastated Dutch maritime trade, cutting the VOC's supply lines at the worst possible moment, just as its finances were already stretched to breaking point. In 1799, almost exactly 200 years after it was founded, the VOC was dissolved by the Dutch government. Its debts, 110 million guilders. Its assets, largely worthless. The shareholders who had received 18% annual dividends for generations received nothing in the end. The Dutch government absorbed the debts. The company that had invented the stock market died in a financial scandal, not a battle. There was no dramatic final defeat, no single villain to blame. Just decades of accumulated dishonesty about the state of the books, finally catching up with an institution too large and too politically entangled to fail quietly. But what it left behind is still with us every day. Every time you buy a share of stock, you are using a mechanism invented in Amsterdam in 1602. Every publicly traded company on Earth, Apple, Tesla, HSBC, every one of them, is a descendant of the VOC's legal and financial architecture. The concept of limited liability, the public stock exchange, the tradable share, the dividend, these are all Dutch innovations from 4 centuries ago. The VOC also demonstrated something important about scale. Before the VOC, the limiting factor on any commercial venture was the wealth of a single individual. The VOC broke that constraint by pooling capital from hundreds of investors, a pooling of capital that built the modern global economy, for better and for worse. A small group of Dutch merchants sitting in Amsterdam in 1602 could not have known they were inventing something that would reshape the world for centuries. They were just trying to solve a practical problem: how to fund a dangerous, expensive voyage without any single person bearing all the risk. The answer they came up with, spread the risk, share the reward, is the foundation of modern capitalism. Whether that foundation has been built on well or badly is a question still being argued today. If this kind of story is what you're here for, subscribe. Next week, the tulip mania of 1637, the first financial bubble in history, and why it wasn't quite what you think. I'll see you there.